Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Battalion Oil.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we're unpacking a situation that is truly shaking up the energy sector.
Oh, absolutely. It's a massive move.
Right. We're talking about market movements that, they genuinely make you do a double take when you open up your brokerage app in the morning.
Yeah, the kind that makes you rub your eyes a bit.
Exactly. When I first pulled up the chart we're discussing today, I refreshed my browser. I just assumed the data feed was glitching.
I don't blame you.
Because imagine looking at a stock and seeing year-to-date gains of over 1,581%.
It's staggering.
And if you zoom out just a little bit, to the one-year mark, you are looking at gains of over 1,219%.
Right.
That is the current very real reality for Battalion Oil. It's the kind of explosive, face-melting momentum that immediately demands your attention if you are serious about wealth beating.
It really is. It's one of those rare setups that just stops you in your tracks.
Yeah.
But our mission today isn't just to gawk at a chart. We need to decode exactly why this massive rotation is happening right under our noses. We're going to unpack the financial turnaround happening inside this company, look under the hood at their operations, and really determine if the very impressive 8 out of 10 bullish rating the stock is currently holding actually holds water for a strategic swing trade.
Because a surge of this magnitude, it doesn't happen in a vacuum.
No, never. It's the result of massive global macro tailwinds colliding perfectly with a very specific micro-level corporate restructuring.
Okay, so here's where it gets really interesting. Let's talk about the absolute fireworks we saw in the market on March 5, 2026.
Oh yeah, historic day for them.
Truly, the price action on that single day was nothing short of historic for this company. We witnessed a massive 15% surge just in the after-hours session alone.
Just in after hours.
Right. But the volatility in the upside, it didn't stop there. If you were watching the tape, there were widespread reports tracking gains across different trading platforms ranging between 110% and 130%, with pre-market moves rocketing as high as 134%. And look, when you see numbers moving that fast and that hard, that isn't just a bunch of retail traders clicking buy on their phones during their lunch break.
Not a chance. Not even close. What you're seeing there is a violent structural breakout.
Yeah.
That level of volume, that aggressive price action, it indicates intense momentum and, much more importantly, strong institutional buyer control.
The big money.
Exactly. The big funds are stepping in, and they are completely shattering prior resistance levels. But to understand why the heavy hitters on Wall Street are suddenly, fighting over shares of Battalion Oil, we have to zoom out.
Right. Look at the big picture.
Right. We have to look at the broader macro environment we're sitting in right now in March 2026. The geopolitical tailwind pushing the energy sector is massive right now.
You're talking about the situation in the Middle East.
I am. We have sustained elevated tensions in the Middle East that have effectively put a concrete floor under global crude oil prices. Those tensions are keeping crude trading firmly between $74.50 and $80 a barrel. And that specific price channel changes the entire economic reality for a domestic oil producer.
Which brings us to the broader market dynamics. Because if I'm looking at my portfolio lately, tech has been taking an absolute beating.
That is the second piece of the puzzle right there.
Yeah.
You have a very active, very aggressive sector rotation playing out across the market.
Yeah.
Institutional capital is rotating heavily into the energy sector.
Yeah.
Precisely because the tech-heavy NASDAQ has been showing significant weakness. It dropped over 300 points recently.
Right. And when big money managers see tech faltering like that, they don't just go to cash.
No, they look for a hedge. They're looking for somewhere to park their capital that offers protection from tech volatility, and they're finding it in energy companies that have massive upside leverage to $80 oil.
Okay, so the macro environment, the Middle East tensions, and the NASDAQ tech wreck, it sets a perfect stage. But here's the thing that really caught my eye in the timeline.
What's that?
The institutions didn't just buy on the open market and drive the price up. They went straight to the source right before the explosion. Let's talk about the massive capital raise that officially closed on March 4th, 2026.
Ah, yes. The timing on that is incredible.
Just a day before that massive 134% pre-market surge, a new institutional investor stepped up and poured $15 million into Battalion Oil through a private placement.
And just to be precise on the math there, after the banking fees and transaction costs, that nets the company $14.1 million in actual usable cash proceeds hitting their balance sheet.
Right. But wait, we need to talk about the terms of this deal because this is where I start to get a bit skeptical.
Okay, let's hear it.
As an investor, when I see a company selling off equity, I want to know the price. What did this institutional investor actually pay?
They negotiated an entry price of exactly $5.50 a share.
See, that is what I don't understand. Contrast that $5.50 entry price with the $11.80 close we saw recently.
It's a huge gap.
It means management just handed these institutional buyers a massive 53% discount to the current market price.
Yeah.
If this company is doing so incredibly well and the stock is rocketing up over 1,000% over the last year, why on earth is management giving away equity at half price?
That sounds a little desperate, doesn't it? Are they just starving for cash?
I know it sounds crazy at first glance, but you have to look at the mechanics of how energy turnarounds actually function.
Okay.
First, you have to remember that institutional private placements are negotiated weeks, sometimes months, in advance of the actual closing date.
Right. So the price was locked in earlier.
Exactly. But more importantly, you have to look at what that 53% discount buys the company. This kind of cluster buying from a major institution isn't just a defensive bailout to keep the lights on.
What is it then? It's aggressive growth capital. Management is willing to take that pricing hit because injecting $14.1 million in net cash heavily bolsters their working capital, specifically to fund new drilling operations today.
So it's a speed play.
Precisely.
They are giving up some equity cheaply so they can immediately stick drills in the ground while oil is still sitting at $80.
You nailed it. They are looking at the exact same geopolitical landscape we just discussed. They see crude prices climbing, and they know that every day they aren't pumping maximum volume at $80 a barrel is lost revenue.
Wow.
That institution isn't just buying cheap shares, they're funding the catalyst for the next leg up. They want to capitalize on those high margins immediately.
Okay, let's unpack this from a fundamental level, because as we always say on this show, the stock price and the underlying business are two completely different things, even if they occasionally rhyme.
Very true.
I want to look at the actual operational turnaround. Is this just hype, or is there a real business here?
The underlying fundamentals are actually what makes this setup so compelling. Let's look at the numbers. If we look at quarter 3 of 2025, their revenue came in at $43.5 million.
Okay.
That represents a 1.6% stabilization and increase from quarter 2's $42.8 million.
Now, I'm going to play devil's advocate here.
Go for it.
A 1.6% revenue increase isn't exactly setting the world on fire. If I see a company growing top-line revenue by less than 2%, I am not usually expecting a 1,500% stock surge.
In isolation, you are completely right. But context is everything in a turnaround play. You have to compare that modest Q3 growth to the broader full-year 2024 picture.
Okay, let's look at 2024.
Back in FY 2024, their total revenue was $193.9 million, which was actually down 12.2% year over year.
Ouch.
Exactly, they were bleeding out. So turning a 12.2% contraction into a 1.6% quarter-over-quarter growth means they successfully stopped the bleeding. They've found the floor.
Fair enough. Stopping a 12% slide is a massive achievement, but still, revenue is only half the story.
And the other half is where the real magic is happening inside Battalion Oil right now. It is all about their operational leverage.
Lay it out for us.
When you look at that same quarter 3 in 2025, their operating income didn't just stabilize, it absolutely skyrocketed. Operating income grew by 639.9% quarter over quarter to hit $826,000.
Wait, over 600%?
Yes.
How does a company mathematically extract that kind of massive operational income growth from just a tiny 1.6% bump in top-line revenue?
Ruthless, absolutely ruthless cost controls. Management has gone in with a scalpel and trimmed the fat across the entire board. Let's look at their SG&A, selling, general, and administrative expenses. They have managed to pull that down to a very lean $3.1 million. They're running a highly disciplined, no-nonsense ship. And because of that intense discipline, their EBITDA margins are sitting at a very healthy 34.4%.
That is a solid margin. But there was another metric I saw in my notes that completely baffled me. I really want you to explain this to me, because anyone with a basic understanding of accounting knows that pumping physical oil out of the ground isn't free.
Right.
But Battalion Oil is reporting a 100% gross margin.
I know, it sounds impossible.
How is a 100% gross margin even possible in the physical energy sector?
It is an incredibly rare metric, And it is usually the result of a very specific intersection of lean operations and accounting mechanics regarding legacy assets.
Okay.
Essentially, it shows that the incremental day-to-day cost of pulling the next barrel of oil out of the ground on their established producing wells is practically zero compared to the revenue that barrel generates at current elevated prices.
I see.
Their fixed costs are already baked in and covered, so every new drop of oil they sell right now at $80 flows straight through. This creates a deeply entrenched operational moat around the business. They have highly focused U.S. oil assets. And because their cost structures are so nimble, they can outmaneuver the massive, slower giants in the space.
I love that analogy. You mean the mega caps in the energy sector?
Exactly. Think about a giant like ExxonMobil. When you have a sudden commodity price spike like crude suddenly jumping and holding at $80 a barrel due to a conflict in the Middle East, a massive corporation moves like a cargo ship.
Yeah, it takes a long time to turn.
Right. They have global logistics, massive overhead, international hedging contracts, and deeply complex supply chains. It takes a significant amount of time for a sudden price spike to meaningfully impact their massive bottom line.
But for a nimble player,
For a speedboat like Battalion Oil, that price spike flows almost immediately and directly to their operational income. They don't have the heavy, sluggish infrastructure holding them back.
wow, that really puts it into perspective.
That is exactly why the stock can surge 134% pre-market. The leverage to the underlying commodity is incredibly direct. If oil goes up $1, their bottom line feels it instantly.
Okay, that paints an incredibly bullish picture. The speedboat analogy makes perfect sense for a momentum trade. But if we are serious about wealth building on this show, we can't just get blinded by the upside and the rocket ship emojis.
No, you have to look at the downside.
We have to look at what could blow up the portfolio. Every 1,500% gainer usually has a skeleton in the closet. What is the catch here?
This raises an important question, and the catch is their balance sheet. It is a very real, very heavy skeleton. Their balance sheet is definitely not bulletproof.
I figured as much. Walk us through the concerning metrics. Just how bad is the debt?
It is significant.
Okay.
Battalion Oil is currently carrying $208.8 million in total debt.
Ouch. And how much cash do they have on hand to service that $208.8 million?
Against that mountain of debt, they only have $50.5 million in cash and short-term investments.
That's a huge gap.
It is. If we look at the broader picture, their total assets sit at $491.7 million, with equity at $191.7 million. When you run the math on that, it yields a debt-to-equity ratio of 108.9%.
A debt-to-equity ratio over 100% is always a red flag for me.
Understandably so.
It means creditors essentially own more of the company's assets than the actual shareholders do.
That is the textbook definition, yes. Now, to be fair to management, that 108.9% is actually an improvement.
Really?
Yeah, if you look at their 5-year peak, that ratio sat at an even worse 117.9%. So they are moving in the right direction, but 108.9% still means they're highly leveraged. They are carrying a lot of weight.
And when a company is carrying that much weight, liquidity becomes the next obvious question. Can they pay their bills next month?
That is where the vulnerabilities get a bit tighter. Their short-term assets are sitting at $84.3 million.
Okay.
The problem is that actually slightly trails their short-term liabilities, which are at $88.2 million.
So they are technically underwater on the short term.
Right. They have a mild liquidity mismatch right out of the gate.
Yeah.
And dragging behind all of that are the heavy long-term liabilities sitting at $211.9 million.
Okay, so they have a mountain of debt, a slight mismatch in short-term liquidity, and they are highly leveraged. But the cost of servicing that debt has to be the most glaring issue here, especially in a higher interest rate environment.
It is absolutely their biggest vulnerability. Their interest coverage ratio is dangerously weak at just 0.4x on $10.5 million of EBIT, which is earnings before interest and taxes.
Let's translate that for a second, because interest coverage ratio of 0.4x sounds like Wall Street jargon.
Easy.
To put that in plain English for you listening, an interest coverage ratio measures how easily a company can pay interest on its outstanding debt. If you have a ratio of 0.4x, it means for every single dollar of interest you owe the bank, your core business operations are only generating 40 cents.
That is the perfect way to visualize it. It is like running a household budget where your mortgage payment is $1,000, but your paycheck is only $400.
Exactly.
You are essentially putting the rest of that obligation on a credit card every single month just to stay afloat. It is a massive red flag.
It is terrifying from an operational standpoint.
When you pair that weak, 0.4x coverage ratio with the brutal net loss they took in full year 2024, a net loss of $31.9 million, bringing their FY 2024 earnings per share down to negative 3 darn cents. You see the absolute knife's edge they're walking.
So if I'm understanding the bear case correctly, if oil prices suddenly tank, if they dip from $80 down to, say, $65, dipping below the thresholds where Battalion Oil can operate profitably, they face a very severe risk of breaching their debt covenants.
Yes.
The creditors could step in. It is a high-wire act without a net.
It is a high-wire act. But this brings us full circle to why that recent $15 million cash injection we discussed earlier was so utterly critical.
Right, the private placement.
The private placement didn't just fund new drills, it bought them survival breathing room. That $14.1 million in net proceeds acts as a buffer against that 0.4x interest coverage ratio. Combined with the fact that their recent ruthless cost cuts mean they are now generating positive operating cash flow, that new capital keeps any immediate threat of crippling shareholder dilution or covenant breaches at bay.
So it bought them time.
Exactly. It's a calculated risk by management, and right now, strictly because oil is holding near $80, the math is miraculously working in their favor.
So what does this all mean for your portfolio? Let's transition into the actionable timelines.
Right.
If you are a listener looking at the setup today, seeing the massive debt, but also the incredible operational leverage and the macro tailwinds, what is the actual play? Are we marrying the stock and holding it for our retirement accounts?
Absolutely not.
I didn't think so.
This is not a buy and hold for 20 years, set it and forget it investment. The framework here is very specific. This is framed clearly as a 3 to 6 month swing trade. You are trading the momentum.
Okay, a 3 to 6 month horizon. What is the catalyst calendar we should be watching over that specific time frame?
The immediate roadmap over the next few months is highly active. First, watch the post-raise action. With that $15 million deal officially closed, you should be looking for immediate operational updates from the company. The market will be aggressively watching for investor calls, detailing exactly how and where that capital is being deployed into the drill bit.
They need to show results fast.
Exactly. Management needs to prove they are accelerating production right now while prices are high. If they delay, the market will punish them.
And then the big fundamental test, earnings season.
That is the main event. Q1 2026 earnings are expected to drop in late April or early May 2026.
Okay.
And the consensus on Wall Street right now is heavily anticipating a massive oil tailwind boost. The expectation is that with the new capital and sustained $80 oil, they will easily, perhaps significantly, surpass that Q3 2025 revenue mark of $43.5 million.
That makes sense.
The market wants to see what that 100% gross margin looks like when applied to sustained, elevated commodity prices over a full quarter.
Bringing it all together, the final investment thesis really hinges on that 8 out of 10 bullish score we mentioned at the top of the show.
Yes.
The goal here is to specifically target the momentum running up to those Q1 earnings in April and May, playing the broader macro rotation where smart capital is fleeing the tech weakness in the NASDAQ and actively seeking high-leverage energy plays.
That is the core wealth-building context here.
Yes.
You aren't just buying a piece of a company. You are buying a highly specific, time-bound setup.
Right.
You are buying the operational turnaround story, just as the geopolitical environment provides the exact macro tailwind they desperately need to print cash and pay down that massive debt load.
And I think that is the ultimate lesson for your wealth-building journey today.
Definitely.
These massive gains, the 1,581% year-to-date surges that make you refresh your brokerage app in disbelief, they never happen by accident.
No, they don't.
They happen when you learn to identify the exact moment when a company with incredible operational leverage, like a speedboat with a hyper-nimble cost structure, suddenly meets a massive macro catalyst, like a global spike in crude oil prices.
Exactly.
When those two forces collide, the price action is explosive, and the smart money is already positioning itself.
But as always on this show, we have to look around the corner and check our blind spots.
Always.
So I want to leave you with a final provocative thought to mull over as you analyze this sector on your own.
Let's hear it.
We know the entire bull case for this swing trade relies heavily on sustained $80 crude. But what if the unexpected happens? If geopolitical tensions in the Middle East unexpectedly de-escalate tomorrow and global oil supply suddenly floods the market, how quickly can a highly leveraged, nimble producer pivot when their primary macro tailwind suddenly transforms back into a brutal headwind?
That's the multi-million dollar question.
It is the multi-million-dollar question for anyone holding this trade over the next 3 to 6 months.
A vital question to keep in mind, and a great reminder that no setup is completely without risk. Always be questioning the market, always verify the thesis, and most importantly, stay disciplined with your timelines and your risk management. Thank you for joining us today, and we look forward to bringing you more actionable insights on the next one. Stay sharp out there.